But what we have to realize is that when we get to those levels, we need to start figuring out ways to start generating significant passive income. Income actually is made when you're sleeping, eating, brushing your teeth, on vacation, wherever you are. That income is still being made. And it's not the same thing as being self-employed. Because yes, if you're self-employed, you're still a little better than those people that are employed. But guess what? You're still trading your hours for dollars too. And you're still, you're still paying relatively high taxes, but maybe you have a little more wiggle room there to offset some of your tax liabilities. But your amount you can make is still limited to when you are actually physically present or actually actively, working at that particular job.
Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Hey guys, how are you today? Thanks for coming back and joining us again on another episode. And today we actually talked to Dr. Julius Oni, and this was a very insightful conversation. We actually got to talk about a lot more than real estate. He is a real estate syndicator, but he has a mission that really touched my heart. And you'll hear that near the end of the episode. It's like how he got started. He actually is an orthopedic surgeon, and his path to becoming an orthopedic surgeon was really based on wanting to help his grandmother, which he ultimately, I'm not even going to give too much detail. I need you guys to listen to this whole episode because it's really good. And he really gives a lot of information and mindset and thought just in his journey that he's gone through and all the years he spent going through school and education to become a doctor, and then how that transitioned into real estate and why he even looked at real estate at all. And he actually had a stint as an angel investor. I won't even say stint because that kind of implies that it's over, but he still is an angel investor, maybe not as actively, but he has in his investments. And so we touched a little bit on that. And I actually got my eyes open to a whole nother world that I didn't know existed. And it's so easy. There's so many different avenues for creating wealth. And it really kind of just depends on where you're starting from, the assets and resources you already have, and what your goals are, where you want to go, and like your risk tolerance and things of that nature. We touched on so many different things that it's really hard just to even pick one thing from the conversation that stood out the most, This is definitely going to be a 2-episode part series because we talked for a long time, but that's how much information was being shared there. And you don't want to miss it. You want to listen to the full episode, both parts. But just to talk a little bit about what else he's been doing, Julius is a CEO and co-founder of XSITE Capital Investment LLC. And that is his syndication real estate company. He has 3 partners, and they all have the mission of bringing opportunities to underserved communities that were not normally privy to this type of information. And does that sounds familiar at all? Because it's very similar to my mission. And that's why I connected so much with him. And that's why we had so much to talk about during this episode. But in any case, listen in, and I hope you enjoy the episode. Please feel free to reach out to him if you have any questions or you want to connect and you find out how you can be involved with his company. He has a lot of educational resources on his website, and you would be very remiss to not take advantage of that. But in any case, here we go. Hi, everyone. Welcome back to another episode of the Share the Wealth Show. This is the show where we talk about strategies to grow, maintain, and develop minority wealth. And today we have with us Dr. Julius Oni. And thank you so much for coming and joining us today. I'm really excited actually to dig into our conversation because I know about you peripherally. I've seen you at some stuff. We've had some light conversations, but I really want to dig in deep and get to know more about you, your company, your mission, and everything that you've been involved with. So firstly, thank you for coming. Secondly,
Thank you.
I gave a brief overview of your background and kind of what we're going to talk about earlier, but can you dig in a little bit on what you're doing now? And maybe, I don't know how far back you want to go, but from childhood or whatever to like, what made you want to be a doctor? And then what made you want to get into real estate? But what was that path like?
That's a great one. Yeah, thank you so much again, Nicole, for the opportunity to speak on your platform and get into this discussion. I was particularly excited to talk to you because obviously we are aligned in our mission to try to expand the minds of people in our communities and to increase the wealth growing capacity of folks that look like us, and certainly we've all kind of gone through multiple different ways or journeys of getting here. But it just warms my heart every time when I see, another minority professional, expanding the mindset, doing it completely outside of the box, and it warms my heart, and I want to commend you on all that you're doing so far.
Thank you.
But to your question, how did I get here? Well, I'm currently an orthopedic surgeon and real estate investor. Well, prior to me identifying as that, I was just Julius Oni, the little kid growing up in small town Nigeria, up until I was about 16, 17, when I made the transition to start college in the US. So came to the US, went to undergrad in upstate New York, and my then proceeded from that, was fortunate to do very well, got into medical school at Howard University, College of Medicine. After that, I was fortunate to match in orthopedic surgery at NYU Hospital for Joint Disease, where I did about 5 years, and finished up my training at Rush University School of Medicine, where I trained in fellowship to be a specialist joint replacement surgeon. Since then, I've been in practice. 3 of those practice years were in Philadelphia at Einstein Medical Center. I had a clinical appointment at Thomas Jefferson, and I then segued from that job into my current position, where I've worked at Johns Hopkins as a joint replacement surgeon for the past 6 years, going into 7 years now. So it's been a windy road, and that pretty much kind of talks about my medical path so far. Now, if you want to talk a little bit about my investment journey so far, obviously prior to becoming an orthopedic surgeon, a little over 9 years ago, or actually a little over 10 years ago, I didn't do much of an investment. There was no money to be invested. But very shortly after becoming an orthopedic surgeon, I actually also didn't invest much either. I think all the delayed gratification of, spending over 14 years, either, from undergrad to finishing fellowship, 14 years of delayed gratification will make you kind of spend money anyhow, at some point, and try to keep up with the Joneses. And that's what, just like any other person who's gone through that experience with not much significant financial education, it's not unusual to just lose your mind for a little bit and find it again at some point. But that moment of just going all out and trying to, buy whatever luxury item you can get your hands on, it was relatively short-lived for me because, even though it was fun, I quickly realized that I didn't necessarily derive that much pleasure from getting, liabilities, if you want to call it that. Um, uh, uh, and I started investing with my first home that I bought. I bought a residential home at that point in Philadelphia, and then thought I was going to start getting a single family home every single year for the next 30 years, and eventually develop this fantastic single family portfolio that I'm going to sell as a portfolio as an alternative to my classic traditional 401k, investment. But I quickly realized that I was a poor landlord because I didn't like to deal with toilets, termites, or tenants really. Uh, and it wasn't because tenants are not fantastic people. I was just too busy with my primary day job that it was kind of tough to be the primary person responding to those folks. And even when I try to use property managers, that just even further decreased my cash flow significantly because you were still responsible and you still had to kind of actively participate in the decisions. If the HVAC machine went out, you still got to pay for it. And you still got to, talk about, all the different options for it. And if the doorknob was broken, then you got a pretty big bill for it, and you have no choice but to pay for it. So quickly I realized that single family wasn't going to be the way to go. After buying my second property, and then
so that was year two.
That was my year two. And then around year two, I discovered angel investing. And so I started because my brother actually had a startup, and I invested in his startup. And then from that point on, I discovered demo days, and I started to invest in different early stage startups, pre-seed round, and with the expectations that these are high risk, high reward investments, and they were like long-term plays. If you're going to be a serious angel investor, you know that maybe 10 to 20% of your investments are going to be the source of the majority of your success. So that was fun. That was really fun to evaluate those companies, and come up with your own little criteria for determining what companies you were going to invest in. But the fact is that was not going to replace my cash flow, and that was relatively high risk, high reward. Thankfully, a good number of them, about 20% of them, are still doing very well. So I think I'm on the right path with those investments. So between the years of 2015 and 2020, the vast majority of my investments were in startups, and I invested in quite a few of them. So around 2020, at the beginning of 2020 was COVID, was the pandemic struck. And for the first time in a long time, I started to question my sole identity as an orthopedic surgeon, right? Because for 3 months I was stuck at home, couldn't operate. And and my identity up to that point was fully encased in my status as an orthopedic surgeon. I love operating. The operating room is my happy place. Anyone who knows me well will tell you the same thing. So all of a sudden I was home. One thing I did discover though while I was home was I also loved hanging out with my family. And I loved the time freedom I had. And I loved discovering other, ways of learning. All the things that were outside of orthopedic surgery. For the first time, I picked up a couple of, fictional books. I picked up a couple of personal development books. My current partner, Leslie Awasam, who was a CRNA, who worked as a CRNA with me at my current job, had mentioned multifamily to me at some point prior to that, but I just kind of ignored it a few times. So I finally got to dust up whatever materials he had shared with me and read a little bit about it. So I started to realize that, man, this is an incredible wealth creating tool that we could use, that I could use to buy some of my time freedom back, that I could use to potentially buy some of my geographic freedom back, that I could use to, spend whatever, do whatever I want with whoever I wanted for however long I wanted, in whatever place I wanted, and that's kind of the definition of financial freedom for me. And so when I realized that this was the case, then the question was, how do you do it? How do you actually start buying apartment buildings? How do you take advantage of the economics of scale that multifamily presents to you? How do you take advantage of the amazing tax benefits of multifamily? How do you take advantage of the fact that it's so recession proof, or maybe not recession proof, but at least recession resistant, right? How do you take advantage of the incredible fact that it's a tangible asset? You actually could touch it. People understand it. And how do you stop democratizing access to this asset? Because when I started looking at all the conferences and started actually engaging with it, I didn't see that many healthcare professionals represented in the folks invested in this asset class. I saw lawyers, I saw business people, I saw engineers, I saw people from varied backgrounds, but I certainly didn't see that many healthcare professionals were represented. And then I saw a lot of people from different ethnic backgrounds. I didn't see that many, Black people. I certainly didn't see that many women, So there were some very clear underrepresented minorities, when it comes to folks that were participating in this incredible wealth generating, asset class. And I at that point, I realized that there was a great opportunity to take the gospel of multifamily into our communities of healthcare professionals and of underrepresented minorities, of immigrants, and of people that just did not have ready access to this asset class. And that's how XSITE Capital was born.
Wow.
So
that story. Oh my goodness. You touched on so much stuff. Like I was sitting here trying to jot down notes and keep up, but it really just goes, okay, let me look through here and see where I want to go first, because I don't know what direction I want to take it.
Well, so, you asked for it. You told me.
Yeah, I did ask for it, and you gave it all. And I love it because there were so many hidden things within your journey that other people can glean from. I think one of the biggest things is we talk about high earners, and especially when you get into, doctors and medical professionals and things of that nature, we talk about lifestyle creep. And we talk about how a lot of times high earners, as they start making more money, they start spending more money and their expenses become higher. So it creeps up with their income. I just shared an article not too long ago that majority of people who make over 200 or families that make over $250,000 a year have either, I forgot what their net worth, or they still live paycheck to paycheck, or something crazy where they just didn't have the assets or the net worth to match their income. But you put it into perfect perspective, because you said it took you 14 years of schooling and struggle and delaying your gratification. So it's not that you don't know how to delay gratification. You have delayed gratification to get to the goal that you wanted to get to, which was that career. But then now it's all right, I delayed gratification long enough. Now I made the money. Now I can spend it. I can do what I want with it. You know what I mean? So that just makes you appreciate more and not scorn the high earners, that just spend all their money on keeping up with the Joneses and the big house and the fancy car and all that stuff, because you really get to understand from a person's their mindset. Because if I had to delay gratification for 15 years before I did anything, because I'm always working, even you make a little bit of money, you don't even have time to spend it because you're busy, rotations and whatever else you're doing.
Yeah, absolutely.
So that is completely understandable. And I think that will speak to a lot of people's mindsets who have made it. And they're maybe the first generation in their family, or someone who's, making a lot of money in a certain career. But now either they're helping their family out who needs help because they're the most successful person. So they're helping people with bills and issues. Then they're also wanting to live a better lifestyle because they've been delaying their gratification for so long.
Absolutely.
But then we kind of stop there. And you have found the key of not just letting it sit there, because like you found out with the pandemic, if you stop working, then what if you couldn't go back to being a surgeon and you had no more income? You know what I mean?
Absolutely.
And it sucks to say you got to delay a little bit longer, but you at least got to put some things in place where you can like still enjoy the fruits of your labor, but then still try to build up for the future. Yeah.
Absolutely. So, I think you make some amazing points there. And I think just to add a little bit to that before you move on to the next point, the fact is, as high earners, as high income professionals, we are just highly skilled wage workers. That's it for the most part, especially if you're in an employed position, right? Mm-hmm. We are highly paid skilled workers is what I meant to say. Highly paid skilled workers, we have a skill and we get a lot of money for it. But with that responsibility or with that kind of pay, especially in an employed situation, comes high taxes, right? So the gross usually looks pretty good, but that means you're like in the highest tax bracket for the most part, or close to the highest tax bracket. And that means your tax liability are going to be much higher. Another thing that really, really hurts us as highly paid skilled workers, particularly medical professionals, is that we usually also have relatively high loan burdens. So you have you do get paid for a good amount, but then you're paying relatively high taxes because as a W-2 income, they take those taxes even before you can see anything, right? And then you have to still pay your loans down because now finally you're making some money, and all those loans you've been deferring, you got to start paying them down. And on top of that, you add the lifestyle creep to it because now everybody's looking at you. You're the orthopedic surgeon, you're the cardiologist, gastroenterologist, anesthesiologist. How come you're still driving your Honda Accord from undergrad or medical school? So you want to keep up with the Joneses. You want to take a nice vacation with your family. You want to buy a relatively nice house so that you're not embarrassed when people come in to see this doctor house. So and then you have kids now. Your kids want to go to like the nice private schools and things like that, and so it starts to add up. So it makes sense. The article you're talking about, that folks that make 200 plus, 1,000 plus, that still living paycheck to paycheck, makes absolute sense to me. But what we have to realize is that when we get to those levels, we need to like start figuring out ways to start generating significant passive income. Income actually is made when you're sleeping, eating, brushing your teeth, on vacation, wherever you are, that income is still being made. And it's not the same thing as being self-employed. Because yes, if you're self-employed, you're still a little better than those people that are employed. But guess what? You're still trading your hours for dollars too. And you're still, you're still paying relatively high taxes, but maybe you have a little more wiggle room there to offset some of your tax liabilities. But your amount you can make is still limited to when you are actually physically present or actually actively, working at that particular job. So, but when you have true passive income, where you just could be sleeping, eating, doing whatever you are, and the money is still coming right into the account, that is when you really are starting to create true wealth. And that's why when you start stepping onto that journey of financial freedom or financial independence.
And and I love that. Okay. And we're definitely going to talk about the real estate side and how people can create that passive income, especially with the multifamily real estate in the field that you're in with your company. But I kind of want to touch a little bit on the angel investing aspect first, because That's so new and so different. Like, not new and different for us, maybe, but I haven't had anyone on my show yet who has been an angel investor, or at least that they didn't share with us. But I know you got introduced because your brother was starting a business and you were investing in his business. So what resources did you find? How do people find out how to be an angel investor? Is there a certain income limit? Because I know I've heard that that's not just open to anybody. Like, if you aren't making a certain amount of money, that those doors are not going to be open. And then that's where, when you're putting seed capital in, by the time it gets to the stock market or IPOs, all the angel investors get bulk of that profit. Like, people who are buying stocks, they're getting the scraps left over. Honestly, like, yeah, you can make money on stocks. I'm not knocking people's stock portfolio. Don't come for me, guys. But you make the risk is upfront. So like you said, it's high risk, but high reward. So first I want to say, how do people even get into that world, and what are the barriers to entry? Like, what do you have to have like checked off on the checklist to be able to angel invest?
So first, to answer your questions, what's the barrier to entry? I think typically you have to be an accredited investor, which is just meaning as an individual, you make $200,000 per year for the past 2 years with reasonable expectation of continuing to make that in the next couple of years, or $300,000 in income as a couple, or $1 million in net worth, right? So those are it's the same thing for multifamily, right? If you're going to do a private placement placement, especially a 506C, which we can go into later, right? You have to be an accredited investor. So it's the same thing. That's just that's the lowest barrier, right? Okay. With regards to the expertise to actually, I guess, get access to
know what you're
companies,
investing in,
and to know what you're investing in, and knowing how to assess them and things of that nature. Just like anything else, it takes quite a bit of research. For me, it was serendipitous somewhat that I kind of fell right into it. So after investing in my brother's company, M-Dash Global, his company was selected into an incubator called Techstars in Austin, Texas. There's another incubator called Y Combinator in Silicon Valley that also has a bunch of like this startups that you can evaluate. But there are actually crowdfunding sites also where you could just like on the real estate side, on this real estate side, you have CrowdStreet and Fundrise. This actually equivalent of that for angel investing, to where you could put, a little bit of money, $1,000, $2,000, $3,000 or whatever, to invest in some of this companies. I am not sure what the names of those companies are, but people can just type in angel investment, crowdfunding or something like that, and they should be able to find that on the internet. I've not done those crowdfunding type angel investments, but because I kind of saw my brother go through the process of trying to raise money pre-seed, or family and friends rounds, pre-seed, seed round, I was kind of able to learn almost alongside of him, and slowly but surely, I started to identify some companies that I would love to invest in, and started to cold call or cold email like founders of those companies, and to say, I've been looking at this for a while, I'm interested, and they would present to me, and I would invest. And eventually I developed enough of a relationship with some of those founders that they, when they discover their friends starting something that they think I would be interested in, they'll pull me in. Or given my background, if it was like a healthcare related startup, they'll be like, "Oh, I have one of my investors who has this background, who may be able to kind of help you with this company," and then they'll pull me in. I'll review it, and either invest or advise or whatever they need me to do. And through that process, I essentially became involved, not just at the investor level, but on the advisory board of at least four of those startups that I invested in. But there's multiple ways to access that. But I think the first thing first is to educate yourself about what angel investments are. Kind of start maybe with, and people could go to the Y Combinator website. You could go to the Techstars website. It's TECHSTAR, Techstar. It's Techstars website. Those are two incubators. One in Austin, one in Silicon Valley. And just reading their websites and kind of seeing what they do alone gives you a nice little idea of how angel investments work and potentially how you can participate, because they have what we call demonstration days, demo days, where you can literally travel to their places and just sit there and listen to multiple startups present.
Wow.
And angel investors all over the country go to these demo days and just listen to different pitches and then decide which ones they want to invest in.
Wow. So those incubators, those are not crowdfunding incubators. Those are normal accredited investor level incubators.
Yeah.
Okay.
So those are absolutely. Those are not crowdfunding incubators. These are great incubators where they literally sieve through thousands and thousands of applicants of founders who have great ideas and want to explore them, and then they select which ones they think they want to help build up or develop. And so they now bring those founders together and provide them with the tools to take their companies from one level to the next.
Yeah.
And by doing so, then present them to, and also then essentially bring them in, develop them, and then bring in a bunch of investors onto their platform to invest in those companies.
Okay.
Yeah.
All right. That's great. And just for everyone who's listening, if you are not accredited, the crowdfunding websites where you can find out about angel investing, those are ways where he was saying you can put in 1,000, 2,000 or something like that. That is for crowdfunding is basically for anyone's income level. So even if you're not accredited, you can play angel investing at a small level just to get your feet wet and get started until you become accredited, since we're working on that. But in any case, okay. Actually, it's just a whole nother world. When you get into real estate and you're surrounded by real estate stuff all the time, you just get used to it. You're engrossed in that world, but then other people don't really realize what's going on. And that's how I feel like when you were explaining about the incubators and these demo days and everybody's traveling, all these angel investors are coming, but that's just their normal world. And we don't know that's existing, because it's so outside of the realm of what, mass Main Street investors and anyone else does. So that's very interesting. I'm definitely going to start looking into that more. Oh, but yeah. So I just think that is something that I would be interested in looking into and just exploring what that world even looks like. But one thing that comes to mind is, do you get a rush kind of the same as gambling with investing as an angel investor? Because I feel like it's high risk, high reward, but it's pulling that lever every time you find a new company.
So I'm actually a poor gambler and I don't like gambling at all. I think this is, so with high risk comes high reward, right? And you cannot make that type of investing your main source of investing if all you playing with is relatively small funds, right? So I wouldn't recommend that. That's all. Someone should just use that as their main strategy to invest. The vast majority of angel investors have actually accumulated a little bit of cash to invest with, and then they use that to invest. So because of the nature of it, so I would say for those that are starting out, Yes. Oh, and I think that company actually for the crowdfunding is Seed Best or something like that. You can have people look it up. Yeah, I think it's Seed Best. Yeah.
We'll put all the links in the show notes to all these different incubators.
Yeah. I think it's or Seed Invest, something like that. It's like Seed Invest. Yeah, Seed Invest. So, anyways, but I mean, I don't get much of a rush from investing blindly. No, all my investments are very educated investments. Right now, one thing I realized quickly over time is that without taking some risks, you cannot really grow wealth. Right. And so my strategy to investment is to do relatively lower risk, higher average annual return type investments like real estate, and combine that with, higher risk. And then that it starts from there. And then the continuum kind of goes on to then, higher risk, higher return investments in stable markets like or developed markets like the US and others. And at the highest level of risk, which I also do, is investments. So in emerging markets where obviously you kind of invest that money and forget about it, but then those actually have the highest return of all. So my investments kind of goes from the lowest risk. I guess the lowest risk is really just living your money in your bank account, but that money is actually losing value a little bit.
Yeah, I don't know if that's the lowest risk. You're risking it in other ways.
No, I mean, you're definitely risking it because, especially with 6 to 8% inflation, that money is losing value on a yearly basis. But you can, I guess, say certificate of deposits, money markets, things like that gives you like maybe a tiny little percentage. Those bonds or things of that nature, and then you can do. And I have a little stock portfolio too that I have a brokerage managed for me, a brokerage account that is managed for me. That's not my main source of investment, so I don't really. I just let them do what they do with it, but real estate is what I'm most passionate about. It's so tangible. I understand it. Now, over the last 2 years, where I've seen it work, and I've seen us help others create wealth with it. So for me, it just makes sense, And to the point that I made earlier, you actually could create stable cash flow also with it, unlike some of these other strategies that I just mentioned earlier.
Yes, very true. So, okay, with that, we're going to move over into the real estate side of things. Okay, guys, don't kill me, but I'm going to have to cut this episode short. This is too juicy, and we need to do this in a part 2. So stay tuned for the next episode that airs, and you can hear the rest of our conversation.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.